يسعدكم مساء أصدقائي الأعزاء. It's a pleasure for me to be with you here today to shed the light on an important topic that is interesting to all of the traders, all of us, which is fundamental analysis. Let me introduce myself first to you. I am Dr. Majid Alayyan, the Executive Director of ACCUINDEX Limited. ACCUINDEX is the talk of the day and one of the most trusted and leading brokerage firm in the region. In fact, I wish that I had enough time to delve deeply on my lecture topic today due to its importance. But unfortunately, as you know, that there is specific time for each speaker that should not be exceeded. In addition to that, unfortunately, I'm not feeling well today, but I will try my best to be as brief as possible. Fundamental analysis, as a definition, it is a way how we look at the market by analyzing certain forces, important forces that affect the demand and supply, and also the market prices as well, which is economic, social, plus political, that are the main forces affecting the demand and supply and also affecting the market prices. In fact, in addition to fundamental analysis, there is two analysis methods more, which is technical and sentiment, as my colleague just explained to you, where the technical analysis focus on the study of historical price action by determining the outlook of the future movement of the market, then make the right decision either to buy or to sell through the use of technical studies, charts, technical indicators, different tools. In fact, technical analysis has thousands of tools you can use. It will be difficult for anyone to say that I am the perfect person in technical analysis. That, in addition to the sentiment analysis, which is used to judge how the other brokers, other traders feel, whether in the overlook of the currency market, also if it's related to particular, let us say, currency or particular pair. Before I move to the next slide, why do we need, guys, such analysis? Why? Why we pay all these efforts to study, to do research, and to analyze the market for what? In fact, all type of research and analysis that we do ultimately aim to achieve two goals. First is to help us determine the market direction and the market trend, whether to buy or to sell, to go long or to go short, either for the currency, for oil, for metals, for any type of instrument or products. In addition to that, which is number two, here we are talking about knowledge. Knowledge. it's enhancing our knowledge, which is very important for every trader. Every trader should be equipped with the knowledge. That in addition to his experience in trading. Knowledge is the most important thing. Knowledge gives you power. Knowledge gives you self-confidence. Even if you act as a trader or you act as a broker to trade on behalf of your clients, they trust you more when you have knowledge. They believe you more. They respect you more. See, that's why knowledge is very important. Imagine that there is a question, why? We have many why. Why? For example, if I ask someone, why you decide to go long gold today? Why you decide to buy euro, dollar today? Why you decide to short crude oil today? Those who have no answer on this why, I don't want to say anything about them. See, you should have answer for every question. You started with why. That's what I'm talking about regarding the knowledge. I decide to go long or short for any instrument based on what? Because I believe that. It's not just only I feel. Through, for example, the economic data that are released from the United States regarding unemployment, regarding interest rate, regarding non-farm payroll, regarding many indicators. See, plus my experience of the technical study, I can decide, I can understand what is the market direction now. It's up or down. Also, it's not enough. To know the direction is not enough. Okay. I am a buyer today. But what is the best level for buying? What is the best level to buy gold or to sell gold? There is another stage. Okay, we are a buyer. We decide to buy at the most good level for me. But after that, what next? Okay, when you can get out, you will just only buy and hold your position for a limited period and with no target. Everybody should have target for his profit, right? But you should know, based on your experience in technical analysis, that market can give me, for example, 60 or 70 points, or can give me $5 or $6 in gold, right? And after that, it might reverse. See, that's why I should decide my entry point and my exit point. Now, to move to the next slide. Talking about the major factors affecting the demand and supply. In fact, factors or major factors are divided into two categories. First category, which is talking about macroeconomic indicators or factors, which includes inflation, interest rate, trade balance, balance of payment, and government debt. Non-macroeconomics factors which related to politics, like let us say a diplomatic relation, like elections, like assassinations, plus unemployment, plus natural disasters, terrorism acts. There are many factors, in fact. But in this slide, we'll explain one by one with example. Starting from number one, politics, political situation, and social stability. Starting from an election, we have an example under political situations, we have election, like the presidential election in the United States, as each president or each candidate present his electoral program, which includes promises about health care service, about employment, about different, let us say, sectors, in order to what? To obtain more votes. Plus, the social instability, which related to poverty, unemployment, also poor healthcare services, also displacement, national insecurity, and political instability. Third one, cross-country disputes and the conflict between countries, and we have a live example now, the current war between Russia and Ukraine, and the impact of this conflict or this war on the supply of gas and oil and some important foodstuff products. Number 4, referendums. And I still believe that all of you still remember the Brexit, where regarding the United Kingdom withdrawal from the European Union, plus international summit and meetings like G7 summit, like OPEC summit, like BRICS, like International Climate Summit. There are many, of course. All of these factors affecting the demand and supply based on the statement released from each of these summits. In addition to that, the speeches and comments by political officials, like speech from the President of the United States, it has strong and direct impact to the market, because the United States is one of the most major countries in the world, and they are a leader. Any statement released or delivered by political officials, right, or even the central bank governors will affect also the demand and supply and also the market prices. Other factors such as fiscal policy and also money printing, deflating the currency, also has impact on the demand and supply. Now, the second factor which affects the demand and supply, we have a group, a list of economic indicators, and this is just only a few examples of that. See, we have GDP, which is gross domestic product. We have CPI, which is the most important, in fact, most important indicator, which is count like second or third important, let us say, indicator in the economic activity. PPI, Producer Price Index. I'm sorry, because there are Arabs. I'm very sorry. If you want me to translate in Arabic, I can do that. Who would like to translate in Arabic? Guys, no Arabs here? You understand English? Good. GNP, Gross National Product, plus durable goods order, retail sales, personal income, unemployment rate, and there is a lot, huge number of economic indicators. For example, non-farm payroll, one of the most important economic indicators. See interest rates, factory orders, a lot. But we just only see an example only. The third factor affecting the demand and supply, which is the actual and anticipated rate of inflation, which we are currently facing. All the countries now, they are facing this problem. Because of what? because of the current war between Russia and Ukraine, and also before that, because of COVID-19 pandemic. Still, we are suffering now since almost 3 years because of the pandemic, as because of also the current war between Russia and Ukraine. Now, inflation, as a definition, inflation, it happens when the prices of goods and services rises. And high inflation is considered as damageable to the economy. Okay, that's why government and central bank should take immediate action to increase the interest rate, to rise the interest rate in order to fight against the inflation. Inflation is damageable. It's killing the economy. Deflation happens when the inflation rate falls below than zero. And here also, in fact, inflation, either inflation or deflation, both of them, they have negative impact. Okay? When the inflation rate falls below than zero and prices of goods also falling, right? It means that there is no more activity in the economy. So that's why central banks and also government should take the immediate decision to lower the interest rate. For what? Why to lower the interest rate? To trigger demand, the demand on the bank loans. You know, in order to encourage the investors and the business to get loans in order to expand, in order to have, let us say, more activity in the market. Interest rates. Can I drink water? Raise the interest rate, lower the interest rate as a definition, and what is the impact on business, on consumers, and so also in markets. Now, rising the interest rate is the effective way to quell the inflation, to control the inflation, to kill the inflation, right? That's why, as you remember, during the previous 6, 7, 8 months, see, what was the interest rate in dollar? And where we reach now? And still we are expecting more increase, more rises in interest rate. See, that's why it is the most effective way to quell and control the inflation. Now, the impact on business, the higher interest rate makes it difficult for the business to get loan, also to expand. Therefore, the employment tends to rise, which eases the wage inflation. In consumer, higher interest rate in credit cards, in personal loans, right, will cool the consumer spending. See, that's why it will affect also the matter of spending by the consumer. Consumer, as I told you, it is the most important, let us say, factor in the market now, see, which is considered as second or third important in the economic activity. On market, higher interest rate will attract investment on bonds and fixed income investment and pushing down the stock market prices. Okay, because investors will escape. They want to be safe. They want to go for safe zone, not to take any risk. Why to lower interest rate? In fact, you know, lowering the interest rate is the opposite exactly of raising the interest rate. But let me handle it. Usually, the central banks or Fed decide to lower the interest rate when the inflation is reached to a lower level, right? and the economy need support, need a boost, need to be more active. The impact on business, it's cut the cost of the capital, improving the profit margin, and encouraging the business to expand, to grow, to expand more. On consumers, lower interest rates create economic activity by stimulating the consumer spending, right? Plus, in addition to that, lower mortgage rates will encourage to increase the home sales and also the mortgage refinancing. On markets, it is exactly the opposite, as I said. And when the higher the interest rate attract the investment to the bonds and fixed income investments, right? Now, by lowering the interest rate, they will come back again to what? To the stock market. They will attract the investment towards the stock market as the bonds and fixed income investment are no longer attractive to them. It is a balance. Number 5, rate of economic growth. Now, slowdown of the economic growth would have negative impact on the currency prices, in the country currency prices. It means that there is a low demand on export from the overseas. Growth of the economy would be positive for the country or the currency. It means that exports are improved and there is a recovery of commerce and industry. Balance of trade. The balance of trade refers to the difference between the monetary value of countries' import and export during the certain time period. See, a positive trade balance indicates trade surplus, while the negative trade balance indicates trade deficit. Trade surplus represents a net inflow of domestic currency from foreign markets, while the trade deficit represents net outflow. Thank you very much, and I hope that, inshallah, we will see you in the next expo. Thank you very much for listening, and goodbye.